If you don't want to pay taxes on your stock and crypto gains, make sure you watch this video to the end, because today we're tearing apart capital gains tax. How's it going, everyone? My name is Dan, but you can call me Malone, and I've spent years slaving away studying every inch of the tax code so I can take all of that dense and boring information and communicate it back to you guys in plain English. Now, whether you're someone who's sitting on gains from investing in stocks, a Shiba Inu billionaire, or if you haven't even started to invest, you might be confused or worried about the taxman. But there's honestly no need to be anxious about tax, and if you are, I promise you'll feel much better after this video. I'm going to tell you everything you need to know about the basics of capital gains tax, how it applies to you, and most importantly, how you can avoid paying it. But before I spill the beans, can I ask that you take 2 seconds out of your day to leave a like on the video? To show my appreciation for leaving a like on the video, here's a fun fact about tax. Did you know that the Swedish pop group ABBA got a tax deduction for their costumes? That's because Swedish tax law allowed a tax write-off for costumes which were proven to be impractical for day-to-day wear. Lastly, if you are new around here and are looking to improve your financial education, don't forget to subscribe to the channel. We'd love to see you back again on future videos. Okay, so in order to understand what capital gains tax is, we need to discuss what exactly is being taxed. Let's say you make the very wise decision to start investing, be it in stocks, crypto, property, doesn't matter. You take €1,000 from your bank account and invest it. We come back 1 year later and that investment has quadrupled in value to €4,000. Now we have an investment worth €4,000, made up of the €1,000 we originally invested and a €3,000 unrealized gain. Notice how I described our gain as being unrealized, but what exactly does that mean? You see, capital gains tax follows the concept of realization, which in literal terms is when something is made real. So when I describe our €3,000 gain as being unrealized, I'm saying that the gain has not yet been made real. But Dan, what are you talking about? Of course the gain is real. I can see it in front of me. And you're correct. The value of your investment has increased. But in the eyes of the taxman, that increase isn't taxable yet. The reason why is because unrealized gains aren't taxed. And if there's one thing you walk away with from this video, let it be that piece of information. So that begs the question. How exactly does a gain become realized, therefore making it taxable? The answer to that question is very straightforward. An unrealized gain will become a realized gain when you actually sell the investment. So you put money into a stock, crypto, or property, that investment increases in value, and you won't be taxed on that increase in value until you actually sell the investment to someone else. This makes sense because up until the point where you actually sell the investment, the gain doesn't represent real money in your pocket. It's just numbers on a screen. But when you sell the investment and make a gain, well, that's real physical money that you've made, and that's what's taxed. So we've established that capital gains tax applies to realized gains. What you now need to understand is that the way capital gains tax and all tax is operated is different depending on where in the world you live. The tax rate, the rules of calculating the gain, and even how and when you pay the tax is going to be decided by the tax law of your specific country. The best example I can give of this is the difference between the US and Ireland when it comes to capital gains tax. The United States have two types of capital gains tax: short-term and long-term. The rate of tax you pay in the US depends on how long you've held the investment and what your income is. Whereas in Ireland, capital gains are taxed at a fixed rate of 33%. End of story. So that's a difference in how the tax itself is actually operated. But what I'm discussing in this video, the principles of capital gains tax are going to be the same for most countries. So if you understand the principles, you then just need to know the specific rules of your country. Principles are very important when it comes to financial education because you need to understand why you're doing what you're doing. We've talked about the basics of capital gains tax and how it applies to you. Now let's answer the question which matters matters most. How do you avoid paying capital gains tax? Knowing how to minimize the amount of tax you pay is crucial to your success as an investor. If you're careless with your investing activity and you're not following a clearly defined strategy, you'll find that your tax bill will become much larger than it needs to be. Using Ireland as an example, 33% of your investment gains gone in an instant. You can imagine the detrimental effect this can have on your returns over decades of investing. So what can we do to avoid this? Starting with the most obvious, but also the most powerful, don't sell. Remember, capital gains tax only arises when you sell your investment at a gain. But if you don't sell, then the gain won't be taxed. The best outlook for any investor, in my opinion, is to invest in assets with the view of holding those assets for at least 20, 30 or even 40 years. But to do that successfully, you need to have a long-term mindset before you make the investment in the first place. Having a long-term mindset towards any investment requires conviction, and conviction requires understanding. The more you understand about what it is you're investing in and why, the more likely it is that you'll be able to hold that investment through thick and thin. It's not going to be as simple as not selling if you made the investment without full understanding, without a strategy, and without an end goal. But if you do go in with the idea that you're not going to be selling this investment anytime soon, you're ultimately going to be saving yourself from the headache and cost of taxes. But let's say that holding the investment isn't an option and you have to sell. In this case, we need to look at tax law to figure out how we can reduce our tax bill. Tax law looks like this, and these books contain thousands of pages worth of rules which describe the various circumstances in which you do or don't have to pay tax, how you calculate it, and how you pay it. As I mentioned earlier, these rules are going to be different in nearly every single country around the world, which makes it virtually impossible for content creators like me to cover every possible scenario that might arise. And that's not something that most content creators will make you aware of. So the next time you're watching a video about American taxes while trying to figure out your tax position in Ireland, just know that you're probably wasting your time. But what we can do is discuss principles, and most countries operate under the same principles when providing opportunities to reduce your tax bill. This is done through either losses, exemptions, or reliefs, and we'll discuss each of these in more detail. Everything we've discussed so far relating to gains equally applies to losses. If the value of your investment falls below its original value, that loss is an unrealized loss until you actually sell the investment, making it a realized loss. Now, obviously realized losses won't be taxed because you can't be taxed if you haven't made any money. But instead, realized losses have a different purpose. They can be used to reduce our realized gains on other investments. Using our example from earlier, we had a €3,000 gain on our investment. But let's say that we also had a €3,000 loss on a separate investment. Now, if we were to sell both of these investments and lock in the gain and loss respectively, our net gain will be zero because the €3,000 gain on one investment will be cancelled out by the €3,000 loss on the other investment. So when all things are considered, we haven't actually made any money and therefore we shouldn't be taxed. The point here is that in most tax systems, you'll be able to use your losses to reduce your gains. Aside from losses, most tax systems will have reliefs and exemptions from capital gains tax that you may be able to avail of. Their purpose is to reduce the amount of gains on which you pay tax. I can't speak to every single relief or exemption that may exist because, as I said, every tax system is different. To use Ireland as an example, we have an exemption where the first €1,270 of gains in each and every year is exempt from capital gains tax. So a similar exemption might exist in your home country. It's just a case of doing a bit of research to find them. Nobody is expecting that you have a detailed knowledge of every possible relief that's available, but having a general understanding of some of the reliefs and exemptions which may apply will go a long way towards minimizing your capital gains tax bill. At this point in the video, I'm going to reveal the most effective way to avoid capital gains tax for all of you who have made it this far. This is the most reliable method for avoiding tax and is far more practical than simply not selling your investments. Even if you sell your investments at a gain, no capital gains tax will be charged using this method. The best way to avoid tax on your investments is to invest using a retirement account. You see, the government really wants you to save and invest for retirement, and in order to encourage you to do that, they provide you with very attractive tax benefits. This means any income earned by the investments in your retirement account, as well as any capital gains on the sale of those investments, will be completely free of tax. This allows you to reinvest the cash into even more investments tax-free. This is an extremely efficient form of investing, and it allows your money to grow in a way that can't be achieved anywhere else. And the earlier you start capitalizing on this benefit, the faster the benefit will compound over time, likely resulting in very desirable returns. Now, the way in which the government and tax authorities reward you for investing in retirement accounts is going to be different from country to country, but generally speaking, they provide some of the best tax treatments for investment returns available. The best thing about these retirement accounts is that they're inherently designed to promote long-term investing, because your money will stay invested in the account until you reach the required retirement age. So again, another key takeaway from this video is to invest using retirement accounts as much as you can. This not only allows you to avoid capital gains tax on your investment gains, but also income tax on your investment income. So that just about sums up capital gains tax. In this video, we've discussed the basics of capital gains tax, how it applies to you, ways of avoiding the tax, and ways of potentially reducing your tax bill. It's worthwhile noting that tax is always in a constant state of change. While our tax systems historically haven't taxed unrealized gains, that might not be the case for much longer, with there being many advocates for such a tax in the United States and around the globe. As I mentioned in a previous tax video, if we were to tax unrealized gains, we will be discouraging individuals from building successful companies. Successful companies are good for economies because they create jobs and promote a skilled workforce. Those jobs give people the ability to earn a living and result in tax revenues for the exchequer. Taxing unrealized gains can also place individuals in very sticky situations because they might be what's known as equity rich but cash poor. The value of their assets might be large, but they might not have enough cash on hand to cover the tax bill on the unrealized gains. The point is that taxing unrealized gains not only opens up issues for the wealthy, but for all of us as investors, as property owners, and as business owners. Now, if we were to ensure that the right people were taxed, then such a tax could potentially work. It's definitely going to be an area of contention going forward, so make sure you keep an ear out for any updates. Ultimately, your job as an investor is to make sure you're taking every step you can to minimize your tax bill and preserve your investment returns. By continuing to educate yourself by watching videos like these and researching elsewhere, you're taking big steps in the right direction. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.